Hey everyone, this is Doug C. Brown with the CEO Sales Strategies Podcast. If you're looking to increase your EBITDA multiple, increasing more cash flow in that business and improving the valuation of that company at the same time, reach out to me at Doug at CEOSalesStrategies.com. That is Doug at CEOSalesStrategies.com. I have Mr. Ben Hansen coming on this call. We're going to talk about profitability and how you can crank the profit up in your business using some very simple but very powerful strategic and tactical plays. So let's go talk to Ben right now. Hey, Ben, welcome to the CEO Sales Strategies Podcast. Thanks so much for being here today.
Doug, thanks for having me. I'm really looking forward to getting a chance to meet with you and try to help your audience double their profitability.
Well, thank you for being here. It's you built an 8-figure business. I think you were an Inc. 5,000, right? Entrepreneur. Yep. I think it was 5 times, right?
5 times in a row. Probably would have been 1 or 2 more if I'd have gotten around to applying a little bit earlier. But that and a cup of coffee will get you on this podcast.
And so let's talk about profit. A lot of people talk about, hey, I'm going to grow my business. They focus on revenue. And that has its place. But what I find a lot of people don't look at is what they're actually taking in for profit until they're actually doing their taxes.
Yep.
And then they're making statements like, I wish my profits were a little bit higher or a lot bit higher. I think you coined that term like profititis or something like that. It's like inflammation, irritation of the profit. So why do you think people aren't looking at the profit in a company as much as they're looking at the revenue in the company?
Yeah. I actually offer a profit myths seminar. When I first started, I was like, what is going wrong with this whole problem or this whole process, or why are people sort of chasing the wrong thing? And it just occurred to me, if you pick up Inc. magazine, the Wall Street Journal, or you go to a cocktail party with other business owners, it's like polite conversation to talk about revenue and rude to talk about profitability and compensation. And when you look at all those magazines in the popular press, everybody's talking about software as a service darlings from Silicon Valley that became unicorns. So it's sort of like the whole myth of entrepreneurship and business ownership typically points people towards revenue. And for many people, they just get sucked into that and they kind of lose sight of, revenue is vanity, profit is sanity, and cash is king. And certainly anybody in the under 100 million crowd, profit and cash are going to be way more significant than growth.
It makes total sense to me. It's kind of like the old myth. Would you rather have a $10 million company at 5% profit or a $2 million company at 75% profit, right? Which one would you rather have? Is it really because of, or should it be because of the mission that they're trying to accomplish? Or, because there is a time to grow revenue. If we're going to be selling our company, let's say, we want to look at, the revenue and the EBITDA side of the business as well. But not every company is going to sell. In fact, many of them don't. But some businesses just, they just want cash flow for the owner, so to speak, right? So yeah. Should we go back to what's the truthful goal of what we're trying to accomplish, or is it something else that we should pay attention to?
So many things to unravel there. But I guess I would say I don't really look at it as that it's like profit or growth. To me, that feels like a bit of a false choice. I think maybe what is more important is where are you in your cycle and which one of those maybe focus areas should be number one at that time, or what should be maybe the ratio of your focus. As you said, most business owners, most CEOs are sort of almost like 150% focused profit. And so what I would say is in general, maybe it should be 20% profit focus, 80% growth focus, but there's more like cycles. If you've been 150% growth focused for 5 years, you might need to get really profit focused for 90 to 180 days to clean up some stuff. And then you could maybe go back and be more pushing on profitability. And just as part of that, it's really dang hard to grow when your profit sucks. And when your profit sucks, it makes everything harder,
Mm.
whether that's stress, growth, cash flow. Often it just stops being fun when things are so broken on the bottom line.
Yeah, if we're self-financing it for sure. I mean, a lot of companies will also take funding, right? And they'll try to
Hmm.
run that number up as high as possible due to the funding. There's the second goal is like, okay, we'll take another round of funding and another round of funding. It's almost like the Amazon model, really, when it comes down to it, right?
Hmm.
But the average business isn't doing that. They're self-funding that process. So profit to me, again, would love your feedback on this. Profit to me, when we're self-funding our business, must be a priority, because if not, then eventually, money in, money out equals something, right? And so if we have no profit coming into the company whatsoever, then we're only going to have a break even or a loss on the company at that point, and that's just the formula for going out of business. So when if we're self-funding the company, should it be a higher look-see at profit versus if we're just getting investor funding in
Hmm.
that capacity?
I feel like behind the question that you're asking, and maybe behind the thinking that a lot of reasonably sophisticated CEOs are doing, is they're thinking that profitability and revenue is a trade-off. Like if I invest some more dollars over here, I could grow faster at the cost of profitability. What I see so often is that there's a buried false idea in there. It sort of suggests that we're already at the most efficient, like, frontier of the trade-off between profitability and revenue. I actually have a slide in one of my decks that's called the profitability and revenue trade-off. And the idea is that if I were to invest another dollar of profit, I could get, another $2 of growth or something. But I think the fallacy there is probably at least two-thirds of businesses are well below that idealized trade-off point of view. And what I mean by that is they can get more profit and growth because they are sub-optimizing how they tackle profitability in the first place. So it's not like they have to sacrifice a dollar on this like idealized trade-off of profit versus growth. It's that they are often not doing the best practices that the top third of companies are doing around profitability. So they're just flat out leaving money on the table. And in fact, that's what we do. We help those companies that are in the bottom two-thirds of the profitability stack quickly adopt the best practices of the top third so that they can double their profitability, often within 90 days. And what I say is to reclaim the dream, that dream of entrepreneurship that got them on this journey in the first place, which often gets really buried when your financial performance sucks and profit and cash are not very good.
So what are some of the best, like, give a couple examples, if you would, of the best practices that the top thirds using that others can like say, oh, that makes sense.
Absolutely. I wanted to pull a thread out of, maybe your playbook, and we could have a little discussion about that.
Mm-hmm.
An example, or I'll give you the rule that we have or the principle, and then we can talk about it more. The rule that I have coined, it's called the 50-20 rule. It's sort of an upside down version of the 80-20 rule or the Pareto principle. So the 80-20 principle says that typically the top 20% of your customers or sales reps or marketing campaigns or products are responsible for 80% of your revenue and profitability.
Mm-hmm.
So it's suggesting like there's an uneven distribution where the best stuff that you do is overly responsible for your best results.
Mm-hmm.
And I think most CEOs and business owners see that all the time. But what I tell people is, hey, If the 20% of your best products or customers or sales reps are responsible for 80% of the goodness, what in the heck is going on with the worst 20%? And so we have this principle, we call it the 50-20 rule, and we say cut half of the bottom 20% in those worst areas. And what I'd like to do is have a quick discussion with you about how that might apply to, for example, sales reps or sales initiatives.
Sure.
So I'm sure you've seen, Doug, and you could tell your audience here, have you seen much of a discrepancy between top sales reps and bottom sales reps? How's that for a softball?
So discrepancy in what capacity?
Total revenue, customer satisfaction, and like margin dollars or net profit created.
Yeah, sure. On the total revenue and margin dollars, it's a lot higher on the top side. Not always customer satisfaction, depends on the particular rep.
Mm-hmm. Mm-hmm. So an example of thinking that you're on the like the perfect an example of thinking you've perfectly optimized your product, your profitability is, hey, if we want to grow, we need to add another sales rep.
Mm-hmm.
An example of 50-20 thinking around your sales team, it's almost guaranteed. If you've got 5, 10, or 100 sales reps, that the bottom 20% of that sales team, unless on a quarterly, semi-annually, or annual basis, you're aggressively removing that bottom 20%, it's highly likely that the bottom 5, 10, or 20% of those sales reps are bringing in approximately zero in terms of positive impact to the company. And so making a change there is an example of improving profitability.
Right.
Now, potentially replacing your bottom 15% of sales reps, if you haven't done it in a long time, with a handful, let's say 5% more sales reps that you think might be better, that will likely improve your profitability and your revenue.
Yeah. Yeah. So, one of the one of the great ways is one of the big problems that companies have in sales teams in general, when they have that big 80-20 or 90-10 or whatever, very rarely have seen the Pareto principle be 80-20 when it comes to sales teams, for sure. Is, the bottom half and the top half, the challenge is that they're trying to find more of the 10 percenters consistently versus
top sales reps.
Yeah.
Yep.
That's the thing. Let's find superstars. We'll just find superstars and it'll solve the problem. Well, superstars can create a lot of problems too. And so what I found is what's lacking many times is processes, systems, training, all of that stuff throughout the company. So we can actually bring that bottom up, like what you're talking about. Some of those people you can just train up, right? They don't have it. So when you start training them up, and let's say they're doubling now their sales productivity, and being much more efficient, much more effective, profit will grow up. The other thing is, just as you said, folks, those of you who can't train those people up, you got to cut the bottom part, because that's the stuff that's dragging you down. So what Ben's saying is, you cut that bottom part and you replace them. Let's just say that they can hit quota. The bottom ones aren't hitting quota, and you can replace them with somebody who hits quota, and your numbers are where they're supposed to be. Now, in high probability, your profitability is going to go up just because they're doing what that other person isn't doing. So I love the fact, when consultants ask me, what do I do every year? I say, cut the bottom 5 to 10% of your customer base and replace them with a higher level client, because you're doing the same amount of work at a lower margin than you would be doing the same amount of work at a higher margin. So I agree. But I like the 50-20 rule, because it's one of those things that a lot of people, they might think like this from time to time, but they won't put this into practice on a consistent basis. And if they looked at their customer base across the board, they looked at their employees across the board, and they were always leveling up, because that's what I'm hearing you do. You're leveling up that process of, this is how, I don't know. I'm going to speak about the New England Patriots right now, right?
There you go.
They were at the top of the game for a long, long time, and then they were at the bottom of the game, and now they're in first place again. right?
Mm-hmm.
Because they have been slowly leveling up the talent, the systems, the processes, the training throughout the process, and it's now showing up. So I
Yeah.
think it's analogous to exactly what you're saying. If you do
So,
this over a
yeah.
consistent period of time, you're just going to see your numbers go up anyways.
So if I were to take a football I got a couple football analogies for your
Yeah.
audience now. The first one is chances are the best way to win football games is to not play your worst players. Now, if you say that, you're like, well, that seems pretty obvious.
Yep.
Now, sure, it makes sense. Let's go get some more Tom Brady's. The problem is, it's hard to find superstars reliably on a budget that fits with everything else.
Yep.
But I'll tell you something that is not hard: identifying the worst players on the team and either replacing them or keeping them on the bench. That is pretty simple. That is automatically going to increase the talent level that is, quote, on the field, right? And so, what I'd like to do now, actually, I think it might be fun. This might be the most important thing that I could share with your listeners. Let me just quickly walk through what we call the profit prescription for doubling your profitability. We offer one on one coaching, and then we actually offer a profit accelerator where, for those people who qualify, we guarantee to double their profitability in 90 days. And we're not full of crap. We actually deliver on this. Okay, so what is that formula? So the first thing is we kind of look at our potential clients in three categories. Are you top quartile profitability? Sorry, not top quartile. Top third, middle third, bottom third. Honestly, the top third rarely seeks us out because they think they've already got their profitability covered. We tend to work with the middle third and the bottom third. And let's just call it, on average, below average profitability. In every industry category, at every size, there is above average and below average profitability. What our goal is to do is to find those folks who are below average, identify which parts of their business are the worst offenders when it comes to profitability, kind of like a triage process, right? And then in those two or three areas, to identify the worst players, if you will, and either keep them on the bench or, even better, trade them to another team, so to speak.
Yep.
And then by, pretty much the law of math right there, if you find the worst part of your business, which is very analogous to the highest opportunity area, and you cut the worst of the worst quickly, it's like a hot air balloon where you cut the ballast and the balloon shoots up. And we routinely see an extra 5 or 10 points of net profitability in 90 days by doing that. Incredibly, incredibly powerful. And my guess is that your audience will be like, either they'll be doubters or they'll immediately get it. It's like, wait a minute. If you cut the stuff where you're losing money, by definition, you will be more profitable. And cutting bad stuff is a heck of a lot easier and faster than finding, grooming, training 5 more Tom Brady's. It is a lot easier to, okay, now we're kind of talking New England. Who's the guy that let the ball roll through his legs in the World Series and you guys
Oh,
lost
no, no, don't
something?
go there. You'll
Okay,
get hate mail
let's
here.
just say it's a lot easier to identify the guys who can't field ground balls
Mm.
and cut them than it is to go find 3 more Tom Brady's. And that is the methodology. Sorry to hit so deep, but it's like the high highs and the low lows of New England sports history.
Now, to that guy's credit, he was not doing well physically, and the coach kept him in there. The manager kept him in, right? So,
I'm pretty confident in general he was a great player, but I was just trying to reach for a New England blooper that, like, if you had cut that out, you would, it's an easy cut as compared to, finding a superstar.
so a couple things that number one, a lot of people are afraid to cut because of the fear of loss, right, or the fear of
Yep.
whatever. The second thing on cutting that I want to be a little careful with people is, folks, we're not telling you to go in there, like Jason from Halloween and take out all of the people, right? What we're telling you to do is surgically cut in the areas you're trimming the fat, not the muscle of the process, if you will. A terrible analogy, but it's I think relevant, because I've seen companies go in Ben, and they just go in, they just like cut. And what they're doing is they're also cutting operational efficiency. They're cutting, customer service, they're cutting sales, they're cutting marketing, right? And they're just
Yep.
cutting all these things that are actually working in the business. What you're talking about is taking the ones that you measure first that aren't working, can't make them performing, and then
Yep.
take those things out and replace them with things that are going to work.
Yep. Absolutely. Um, the goal of the other thing is when people have a cutting mindset, in many cases, they're thinking like cutting expenses.
Mm,
And we're a big fan of cutting expenses smartly, but let's talk about cutting customers. You even alluded to it,
yep.
right? So if you look across the book of customers that you have, or your customer profiles or target audiences or whatever, almost guaranteed that the top target audiences or target customer segments are really performing well for you, and the bottom are typically losing you money. I actually offer a white paper on my website, and there's just all sorts of statistics from Deloitte and Harvard and McKinsey and whatever that those companies that trim their worst customer segments get a big lift.
Yep.
Typically, by cutting the worst 10 to 20% of customers, you immediately get a 10% lift in net profitability. And a 10% increase in net profitability is gargantuan. It is the difference between being bottom quartile typically and second from the top, or first and third.
Yeah, actually, McKinsey put out a study that referenced 92% companies are not they're staying in resources that aren't performing for them, 92% of the companies.
100%. 100%.
And if they reallocated those resources to more profitable areas and they doubled down in those areas, so to speak, they
Yep.
reallocated. Now, we're not spending any new money, guys and gals. We're just
Yep.
taking the money that's existing and moving it into something that's working better. Then they see a lift in all kinds of,
For sure.
numerical, but also, customer happiness,
Yep.
employee happiness, all of this stuff goes up, right? So employee retention stays longer, people can get paid a little bit better, all of these things. So, but I know a lot of folks when they listen to this, then they go, I don't want to get rid of these, people, right?
Yeah.
I don't want to
Yep.
get rid of these processes. We've been doing this since, when I was in the military, they used to go, we've been doing
Yep.
this since Korea the same way. And it's like,
Yep.
well, we're now in the mid 80s, right? I mean, it's times have
Yep.
moved on. And so, people have this aversion to
For sure.
change sometimes, right?
Yeah. Let me.
What would you say to people who have that aversion to change? What's kind of like the prescriptive method to sort of say, okay, we're here in a little bit of fear. We got to get you to neutral and then get you to that buying confidence.
For sure. There's a long answer and the short answer. I mean, I think the short answer is the psychology of profitability is so huge, and in many cases, it does. How can I? Let me go backwards. Profit psychology is so big, it is 1/4 of our profit prescription and methodology. It is why we only work with companies when we are working directly with the CEO, because without that top down
Mm,
focus around profitability and what it takes, to reallocate, let's just say, means cutting these 5 products in order to move some of that energy and resources to these 5 products. It is rare that without sort of top down push, you're going to get the organizational willpower to take action there. So I don't know if that's the short or the long answer, but profit psychology is critical. And that's why we build it in so deeply into the work that we do here at Profit Doctor, because we know that it starts with, I mean, again, the first thing to overcome are those profit myths. And the number one myth is this growth mindset where people are spending 150% of their time and so focused on growth, 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 and like just keeping the trains running rather than thinking, hey, what in my organization should not be there? And if it were not there, would really free up a lot of resources to either bring to the bottom line, reinvest in our company, or reinvest in the things that we're doing great.
That point is, let's drive that one home. CEOs, owners, you are not going to delegate this responsibility to someone else in your company without you having an active role in the process. Like, just
Yeah,
let's get right to the point. Here's the thing. It's your money or their money, right? When people are spending their own money, they take it seriously. When they're spending your money, they may take it seriously, but you as the CEO or the owner must be the driver in this process. If you don't, it won't work as well because you've got to, and the reason I bring this up, Ben, is you and I have probably been in this situation. I'll speak for myself. I've been in this situation many times where CEOs of companies or the owner of the company, like, oh, I'm just too busy. I don't want to deal with this. And they push it off to people, and they're not driving the directive of you're reporting back to me.
yeah,
And this is going to be where we are. They're not leading the company. They're pushing that leadership role off. And it is a disaster for them
yeah,
when they do this. And so I'm pushing back on all of you for this reason. I don't
for
want you to
sure.
get hurt, because, people do weird things when they're not in your position. Like, they
Yeah,
don't
I mean,
think like the owner. They don't, it's not as important. Or, let's say you're a $25 million company. You own this company, you birthed it, you brought it up, and you've got people now that are making, I don't know, $300,000-$400,000 around you. They still don't have the same ownership mentality that you have most of the time.
for sure. I mean, I think the soundbite is you can delegate to people to say yes, but you can't delegate to people to say no. And most of the things that go on around driving more revenue tend to be yes-oriented decisions. Which one of these things are we going to add is usually how people think about
Yeah.
it or spend more money on. But profitability tends to be on the other side of the house where you need to say no to stuff. The profitability levers tend to be getting rid of things that aren't working, which is the equivalent of saying no. And saying no is CEO work. You can delegate a lot of the saying yes stuff, but you can't delegate saying no.
It's well said, sir. So, Ben, how do people get a hold of you, learn more about you and your company?
Great. Thanks for throwing me that big softball. It's profitdoctor.com, spelled the regular way, PROFIT, and then DOCTOR. So it's profit like money, not Moses. It's doctor spelled the regular way. I would recommend people come there and check out some of our tools. We offer a profitability leakage detector that can really, really jumpstart your effort to improve profitability. It is essentially a triage tool that goes through the 10 most effective ways to improve profitability. The flip side of that is it uncovers, or it does this by uncovering the 10 most likely culprits of how profitability is leaking out of your company. And so you kind of go through that, and then you might want to try to book a call with us so that you can go through that to see if you filled it out right. Because when we show you which of those 2 or 3 levers could each give you 5 more points of net profitability, that is basically us sharing with you the best practices of top quartile profitability companies in your size category, in your industry. And by yanking on those 2 or 3 things, you can probably add 1 or 2 quartiles worth of profitability very quickly. And I invite you to check out our profit accelerator, which is essentially a 90-day program where we help companies walk through that. And one of the things you said, Doug, was how difficult the psychology is and that sort of thing. Intellectually, it's very easy to think we should stop doing dumb stuff that's costing us money. But to go from there to identifying which products, customers, and employees shouldn't be there,
Right.
and taking action, there's a lot of miles to walk, mostly between your ears, to get there. And that's what we do. We help people identify what those levers are, and then get over the hump internally, that profit psychology, so they can have what we call winning CEO mindset, take that action, and become a top quartile profitability company. Which I got to tell you, um, we turn a lot of frowns upside down here.
Well, Ben, thanks so much for being here on the CEO Sales Strategies podcast. Thanks for sharing all this information. Folks, if you'd like, reach out to profitdoctor.com and it's a downloadable, I'm assuming, the profit leakage.
Yeah, I think you can just go to profitdoctor.com slash, and shoot, I should know better. It's either leak or leaks.
Okay.
But one of those is going to get you there. And now I'll need to put a redirect up so that leak or leaks all go to the same place. But it allows you to download this free tool that, like I said, it's a very, very powerful triage system. And, it's free.
Awesome. Again, Ben, thanks for being here on the CEO Sales Strategies podcast. Thanks for bringing your A game.
Thanks, Doug. I appreciate it.
All right. What did you learn from today? Did you learn that profitability is actually not that hard to increase when you know how to do it? So it's an education process, then it's a skill process. And as you get educated and you add the skills and you add the action behind that, you will find higher profitability in your company. Whether you're using the 50-20 rule like Ben brought forth, where you're taking the bottom part of the 20% that really isn't producing all that well, and you're making that much more effective and efficient, and therefore you're improving that bottom line, increasing the profitability, or other methodologies, whether you go get the profit leak detector, that leakage detector he was talking about. And remember, that's at profitdoctor.com/leaks. And you can download that sheet and take a look at that for yourself. Listen, here's the thing about profit. Most of the time, increasing profit is not that hard to do. It's usually very simple things, very logical things. The challenge is for most companies, they have no system, no process around that, and there's not that focus on it continuously. And that's what really kind of eats away at their profits as they're going along. They just don't know, right? So dive into the subject. I highly recommend that you do. If you need some help, you got people who can help you. All right. If you'd like to talk to me directly, just send me an email at doug@ceosalesstrategies.com. If you're interested in improving that EBITDA multiple, right? Maybe you're thinking of an exit down the line, or maybe, by the way, if you're thinking of an exit, you want to do this earlier than later because you want to structure the company for the other company to be able to come in, or the other investors to come in and look at your company as what it should be. An increased multiple on that EBITDA will give you far more valuation, far more money at the end, but you want to do that earlier than later. You don't want to get caught, while they're doing their due diligence process, because what they will do is lower their offer if it's not in alignment. If you want more cash flow, whether that's for now or for the future, you could do that in the same way. Reach out to me. Be happy to have that conversation at doug@ceosalesstrategies.com. That's the email. Best way to get a hold of me. All right. Also, if you love this episode or any of these episodes, I'd ask you, please go give it a 5-star review. I'd be forever grateful. I know it takes a few minutes, but it's one of the ways that, and frankly, it's an ego stroke for me, because when I see more, hey, this was great, it gives me, frankly, an ego boost. How's that? So if you want to help out a brother with an ego boost, go up and please give that a 5-star review if you agree with that. All right. Until next time, go out and sell something. Go out and sell a lot of it. Remember, play win-win-win. They win, you win, someone else wins. Best type of sale in the world. Do not have to discount, just have to convey the value perception that they're seeking and fit into their situation. And again, if you'd like to reach out to any of us here, reach out to me first, doug@ceosalesstrategies.com. All right, go out and make it a great day. Make someone happy. Make yourself happy. To your success.